Let us see the next question. ABC Limited is planning to invest in a machinery for which it has to make a choice between two identical machines in terms of the capacity X and Y. Despite being designed differently, both machines do the same job. Further details regarding both the machineries are given below. For machinery X and machinery Y, purchase price is given, life is given, per year running cost is given. Discounting rate is 9%. You are required to identify the machinery which the company should buy. The present value factor at 9% is provided to us from end of year 1 to end of year 3. Please go through the question, all of you. So friends, over here, my question to all of you is that what kind of information is provided to us with respect to the revenue? I have that question to you. Yes, everybody has answered correctly. That sir, in this question, no revenue information is given. We have been provided with the cost information and we are required to say compute that say the which machinery has a lower cost. That is the way we are required to take the decision. I request all of you to do step number 1 to step number 3 on your own for both the machinery simultaneously. For X machinery, for Y machinery. Try to do first 3 steps on your own. So let us start with the answer. Step number 1, in that write down investment. In that machinery X and machinery Y. In both of them we will write purchase price. It is year 0 cash outflow, that is investment. For machinery X it is 15 lakhs. For machinery Y it is 10 lakhs. Step number 2, depreciation. What is depreciation for machinery X? Friends, over here we understand that the question does not provide the tax information. So there is no need to compute the depreciation. So write down answer. Depreciation is not required to be calculated comma because tax is not given. Step number 3, terminal cash flow. It is again 0 because no scrap value of the machinery is given. Step number 4, recurring cash flow. For machinery X and machinery Y, year 1 to year 3 and first and second year. Running cost is only the recurring cash flow. Running cost is 4 lakh rupees per year and over there it is 6 lakh rupees per year. That is the only recurring cash flow. Step number 5, in that working note number 1, calculation of present value cash outflow for machinery X. So year 1 to year 3 cash outflow is 4 lakhs. Discounting rate at the rate of 9%. First year factor is 0.917, second year factor is 0.842, and third year factor is 0.772. So year 1 to year 3 factor summation 917, 842, 772, 2.531. Present value 2.531 into 4 lakhs. So 10 lakh 12,400. 10 lakh 12,400. Okay. So this is the present value 10 lakh 12,400 plus investment, that is an amount of 15 lakhs to be made in year 0. So this is the present value cash outflow for machinery X, 25 lakh 12,400. Whatever we have done for machinery X, similarly we will do for Y. Working note number 2. Calculation of present value cash outflow for machinery Y. In that, say year 1 and year 2. Cash flow is 6 lakhs. Discounting rate 9%. First year factor is 0.917. Second year factor is 0.8420. 1.759. Into 6 lakhs. So 10 lakh 55,400. 10 lakh 55,400. Plus investment, an amount of 10 lakhs. So the total comes to present value cash outflow 20,55400. This is the way the present value cash outflow can be calculated. Friends, I want you to tell me that which machinery we should buy, X or Y. Yes, almost everybody has given correct answer. That sir, at this point of time we cannot make a comparison. Why we cannot make a comparison? Because this is the present value of the cash outflow in year 0 and it is of 3 years. And this is the present value of the cash outflow for a time period of 2 years. So both of them are not comparable. What we should do? We have to make both of them comparable. How we can make them comparable? It is very simple. Everybody is requested to pay attention over here. Machinery X and machinery Y. Present value of the cash outflow 25 lakh 12,400. 20 lakh 55,400. It is useful for 3 years. It is useful for 2 years. So we understand that over here, this is the expense for using the machinery for 3 years. Then what is the annualized expense that we will compute? This is the present value of the cash outflow for using it for 2 years. Then what is the cash outflow in annualized term that we will compute, and based on that say we can take decision. So what we can do, we can make the calculation of equalized annual cash outflow. It will be calculated as present value cash outflow divided by PVIFA at K cost of capital for n number of years. This is the way we can make the calculation. This can be done for machinery X and machinery Y. As far as machinery X is concerned, it is 25,12,400. 25,12,400 divided by PVIFA at the rate of 25% for 3 years. I'm sorry, at the rate of 9% for 3 years. Yes. So 9% 3 years factor will be found like this. It is 0.917 plus 0.842 plus 0.772. So it is 2.531. The numerator is 25,12,400. So the final answer is 9,92,000. 9,92,651.13. This is in case of machinery X. For machinery Y, we will have the similar working. Present value of the cash outflow is this 20,55,400. 20,55,400 divided by PVIFA at the rate of 9% for 2 years. So 20,55,400 divided by first year factor is 917, second year factor is 842. So first and second year factor summation 1.759. So 20,55,400 upon 1.759. So 11,68,504.83. This is the way, so we are required to make the calculation. And we will select machinery which is having lower equalized annual cash outflow, that is machinery X in this example. So friends, over here, the company would be advised to buy machinery X. Right on answer? The company should purchase machinery X. Full stop. In that, write down with paragraph. Importantly, over here, PVCO for both machines are of different number of years. Full stop. So we have to compute EACO, Equalised Annual Cash Outflow for both machines, comma, for decision making. Full stop. EACO, Equalized Annual Cash Outflow, is indicating annualized cost of using each machinery. Full stop.